Hey, this is Justin with daytradethemarkets.com, and in this video I want to talk about a concept I call context first, then trade setup. Okay, and I think this is a really important concept. In fact, I would say it's probably the single biggest mistake that most traders make, especially newer traders. I know personally that I made this mistake consistently without knowing that I was making it. I made it for about 7 or 8 years going back to the start of the century, and it was just a disaster that whole time. When I finally was taught a new way of looking at things, it really made all the difference. It really shifted things for me. So I think that if you're not trading as well or having the results that you'd like, and you're a relatively new trader, I would guess there's a very high likelihood you're making this mistake. So before I get into the details of that and why it is, let me give a little bit of a background in terms of the way that most of us, most traders approach things, right? We typically go on this quest for a trade setup, and whether we purchase a trade setup or we try to figure it out from reverse engineering what we're seeing on the chart, whatever it is, we look for this trade setup. We look for this great entry technique, right? We back test it, we sim test it, we get all the data together, and it looks pretty good. And almost invariably, once we put it into live trading, it doesn't quite hold up the way we thought it would, right? Just doesn't quite work. So we go back to the drawing board, try to fix it, add some filters, or start over and repeat the cycle. And again, I did this for years and years and years, and it was a disaster. I mean, I remember going back into or going at an old place. I used to go down to our basement, like just this cave, and spend hour after hour after hour at night trying to figure out my trade setup, trying to figure out what do I just have to figure out one more indicator, and I'll have this, right? That was my thinking. Another way that a lot of ways that it can happen, and this is actually a little bit better, is you actually find a trade setup that works pretty well, right? But you find that in some conditions it works and in some conditions it doesn't. And again, most of us try to add filters or try to add different additional indicators to try to figure out how can I get rid of some of the bad ones and keep the good ones, because I know I've got something here, but it's not quite working the way I think it should all the time, and it's just a confusing situation, and it's a very frustrating thing, especially for newer traders. But the common denominator there, the common story, and this is just the way it makes sense why this is, because it certainly appeals to the way our brains are wired. We're looking for a very concrete black and white trade setup. We're taught trading, generally speaking, as entry focused, right? We want to figure out our trade entry setup. There's nothing inherently wrong with trade entry setups. It's the way that most of us go about doing it that's the problem. So in other words, we want to find that rule X and then indicator Y and indicator Z. And when this lines up and that lines up and the other thing lines up, then we've got our trade, and we just take our trade and we're robotic about it, and it sounds great. It seems perfect. The challenge is that different conditions require different strategies. And I love this image here, this set of images here, because you can see intuitively this makes sense when you're driving, right? You can drive a lot differently on a straight, dry road in the sunshine when it's 80 degrees than you can when it's freezing conditions on a winding mountain road, right? We understand that intuitively. The challenge is that in terms of when a trader is trade setup focused, they're looking for their trade setup to be, to come into play, and then they take it and they hope it works. So in other words, if you think about it in terms of the way that the market generally works, we have a situation where the market's in a horizontal or a balance condition or a consolidation condition, and then something changes and we go vertical, or we're in imbalance and then we find balance again, and then it breaks vertically again, and that's the pattern that the market is always going back and forth in whatever time frame you're looking at. So you might have a momentum or trend based or breakout based trade setup, and if that setup comes and we happen to be in a vertical condition, great, you're going to be in great shape, it's going to work. However, if you take that breakout or momentum or trend based trade and you take it right into an area of consolidation, or if you take it when we're in a balanced condition, you're going to get your head ripped off. Or vice versa, if you like to fade the market, it's going to work great when we're in the horizontal condition. You try to fade the market when we're in a vertical condition against you, you're in a lot of trouble. So again, if you're thinking about your trade setup first, you're basically taking the trade and hoping that it's in alignment. Again, the solution then would be to think about context first. There's nothing wrong with trade setups. I teach different trade setups. The problem is when you're first and foremost focused on your trade setup. Now compare that to a situation where you're more context focused first. You're trying to understand the story of the market. You're trying to understand the condition that the market's in. Again, are we in a straight line, dry easy, good conditions to drive, or are we in a windy mountain road? If we can determine that first, then we can determine when it makes sense to apply a certain setup and when it makes sense to pass on that setup. Okay, so again, you're asking yourself, does the market's context or story match the trade entry you're about to take, the setup that you just got? Okay, and if it doesn't, or if you're not sure, you don't take it. If it does, you take the trade. Okay, you can kind of, if you think about it again, on the left here, we have an unsuccessful trader or an approach that's unsuccessful, generally speaking, right? So again, it's trade setup appears. I'm a rule follower. I follow my rules. I take it, and if the market happens to be in the right condition for my type of trade, great. I'm going to look great. I'm going to feel smart. It's going to feel good. I'm going to feel like a winner. It's going to go well. However, if the market happens to not be in the condition that's conducive to that type of a trade, then I'm in trouble. Now compare that to the image on the right here, where you've got a trader who is trying to make sense of the market first. So context first, then and only then you apply the trade setup that makes sense with that context. Okay, it's a subtle thing, but I can't express how big of a deal it is. It certainly was for me and for a lot of people I've worked with. Let me put it that way. I'm not saying it's the only way. I'm sure there are some people that can be robotic about it, but for the vast majority of successful traders, they think about it in terms of context first, then and only then their trade setup. So that leads obviously to the next logical question, which would be, if context first is so important, then how do you go about putting the market in context? How do you make sense of the market? How do you know if buyers or sellers are in control? How do you know if we're in more of a trend day or a consolidation day? And that's where this concept that I teach, called the 2 out of 3 method, comes in. What we're trying to do is we're trying to make sense of the market story or context every day. The market is telling you a story if you know how to read it. And so the way that I do this, and you can add other pieces of evidence that you might already know as well to the mix, but I look at it as identifying 3 different or evidence points, 3 main evidence points. And the more of these evidence points that come together or reach the same conclusion, the better, right? So, if you look at the image on the left, it's a unicycle. It's like having 1 out of 3 evidence points, okay? You can certainly do it, and if you're an expert, it looks great and you look very smart, but it's certainly risky. You're going to fall when you're riding a unicycle, especially until you're an expert, right? You can do it. You just have to know what you're doing, okay? Now, 2 out of 3 is like riding a bike. There's still some inherent risk there. Anytime you're riding a bike, you could take a spill, of course, but we all know how to ride a bike, and it's a pretty safe thing to do, and we have a pretty good edge, and we know that we can make sense of it. Now, 3 out of 3, not that I see a lot of people out on adult tricycles, but it's the idea. There's still no guarantee. You could still wipe out, but you're a lot more stable, okay? You're still, it's not 100%, but you're going to have a situation where if you have 3 out of 3 evidence points that are lining up, you've got a pretty good setup. So you've got a situation where the context is telling you, hey, I've got it right now, or I have a pretty strong edge right now. It's worth applying some risk right now. It's not going to work every time, but that's the concept. That's the methodology that you want to think about. So in another video, a subsequent video, I can talk about breaking down each of these 3 evidence points in a lot more detail. But just wanted to talk about this idea of, again, context first, then take your trade setup that applies to that type of market story or market context, rather than being a setup first focused trader who just hopes that the market happens to be in alignment with the type of trade that you're taking. So anyway, hope that was helpful. Let me know any thoughts or questions you might have, and we'll talk soon. And again, I'll do another video shortly on the different 2 out of 3 different pieces of evidence. Okay, thanks a lot.